When everyone else is losing, the one who planned for the loss wins. That is the specific form of strategic genius that separates the tactician from the strategist. The ability to see not just the immediate board position, but the trajectory of the game across multiple moves, to identify the conditions that others are managing as crises, as the specific opportunities that careful preparation has positioned you to exploit. To look at an oil market in turmoil, at the geopolitical fractures that are disrupting supply chains and destabilizing production in regions that the world depended on for reliable energy, at the specific combination of Iranian instability, Russian infrastructure damage, Red Sea disruption, and global energy demand dynamics that is creating the most volatile oil market environment in a generation. And to recognize it not as a problem to be managed, but as the specific conditions that a strategy conceived years ago was designed to produce. Mohammed bin Salman planned for this, not in the sense that he created every element of the current oil crisis through his own agency. The Iranian succession crisis, the Russian infrastructure damage, the Red Sea disruptions are products of dynamics that extend far beyond Saudi decision-making. But in the specific sense that his oil strategy, the production decisions, the OPEC Plus management, the non-dollar pricing development, the strategic relationship cultivation with every major oil-consuming nation was designed to position Saudi Arabia to gain from exactly the kind of market volatility and supply disruption that is now materializing. MBS's strategy is working, not perfectly, not without complications and costs that honest analysis must acknowledge, but in the fundamental directional sense that matters most for strategic assessment, Saudi Arabia is gaining as the oil crisis deepens. Its revenues are increasing in conditions where other producers are struggling. Its strategic leverage is expanding in conditions where its adversaries are contracting. Its Vision 2030 funding position is improving precisely when the fiscal pressure of recent months suggested the program might face its most serious resource constraints. And its position in the emerging global order is consolidating in the specific way that a calculated, patient, risk-tolerant long-term strategy produces when the conditions it was designed for finally arrive. Let's understand exactly what is happening in the oil market, why it has happened in the specific form it has, and why Saudi Arabia's position within it is the specific product of strategic choices that MBS made years before the current crisis materialized. The oil crisis that is deepening in 2026 has three primary drivers, whose interaction is producing market conditions more volatile and more consequential than any single driver would generate independently. The first driver is the Russian production disruption. Ukraine's sustained campaign against Russian oil infrastructure, the refinery strikes, the pumping station attacks, the export terminal damage documented in the previous analysis, is producing a measurable and sustained reduction in Russian oil export volumes that is only now reaching its full market effect. Oil markets are forward-looking in their pricing, but backward-looking in their supply assessment. The actual volume reduction that Russian infrastructure damage is producing is being incorporated into market supply calculations with the lag that physical commodity markets always exhibit between production disruption and market impact. The full supply reduction from accumulated Russian infrastructure damage has not yet been priced into the market with the accuracy that the physical reality demands. The gap between the physical supply reduction and the market's current assessment of it is closing in a direction that benefits every other producer. Russia was producing approximately 10 million barrels per day before the infrastructure campaign began. The cumulative damage to refinery capacity, pumping station operations, and export terminal throughput is reducing the effective export volume in ways that independent energy analysts are now assessing at between 5 and 15% of pre-campaign levels depending on the specific measurement methodology used. A 1 million barrel per day reduction in Russian export availability is a supply shock of the magnitude that moves oil prices by $10 to $20 per barrel in supply-constrained market conditions. The supply reduction that Ukrainian strikes are producing is approaching that magnitude and is still growing as the infrastructure damage accumulates faster than Russian repair capacity can address it. The second driver is the Iranian supply uncertainty. The Iranian succession crisis, the food shortage, the IRGC institutional radicalization, and the specific combination of domestic instability and external pressure documented in previous analyses are creating a supply uncertainty premium in oil markets that reflects the genuine possibility of a significant disruption in Iranian oil production, either through the direct physical disruption of conflict or through the political disruption of an institutional crisis that affects the operational management of the production and export operations that keep Iranian supply flowing. Iran produces approximately 3 million barrels per day, a figure that has been sustained through the specific sanctions, circumvention arrangements that Chinese purchases and other mechanisms have maintained. Any significant disruption to that production, and the current combination of domestic crisis and potential military escalation associated with the nuclear program, creates genuine uncertainty about whether disruption is coming, would add a supply shock on top of the Russian disruption that the market is already absorbing. The uncertainty premium that this possibility creates in market pricing is contributing to the price environment that Saudi Arabia is benefiting from. The third driver is the Red Sea disruption's effect on global oil logistics. The Houthi maritime campaign, whose operations have been degraded but not eliminated, and the broader Red Sea security environment that the previous analyses documented, are adding a logistics cost and delay component to the global oil market that affects producers and consumers differentially. Producers whose export routes avoid the Red Sea face lower logistics friction. Producers whose supply chains depend on Red Sea passage face higher costs and longer transit times. The specific geography of Saudi oil exports, predominantly through the Persian Gulf and around the southern tip of the Arabian Peninsula or through the Red Sea to the Suez Canal for European markets, gives Saudi Arabia choices about routing that other producers facing the Red Sea disruption lack. Now let's look at why Saudi Arabia specifically gains from the combination of these three drivers, because gains are not automatic for all producers in a disrupted market, and the specific form of Saudi advantage requires explanation. The most direct gain is revenue. Higher oil prices, produced by the supply disruption and uncertainty premium that the three drivers create, translate directly into higher revenue for Saudi Arabia as a major producer. The fiscal arithmetic is straightforward. Each additional dollar per barrel in the average oil price adds approximately several $100 million to Saudi annual revenue at current production volumes. Price movements of $10 to $20 per barrel add billions to Saudi annual revenue. The fiscal pressure that MBS's deliberate production increases imposed on the Saudi budget to serve his geopolitical objectives, the pressure documented in the previous oil strategy analysis, is being relieved by the market price movements that the crisis is generating. But the revenue gain is only the most direct and most immediately visible dimension of Saudi advantage. The more consequential gains are strategic. The market share gain is the second dimension. Russian export disruption is creating a supply gap that other producers are competing to fill. And Saudi Arabia, as the world's largest conventional oil exporter with the most significant available spare production capacity, is the producer best positioned to fill that gap. Saudi Arabia's spare production capacity, the ability to increase output rapidly in response to market opportunity, is estimated by independent analysts at between 1 and 2 million barrels per day. Deploying that spare capacity into the gap created by Russian export disruption allows Saudi Arabia to simultaneously support its own revenue position, strengthen its relationships with the major consuming nations whose energy security it is serving, and demonstrate the specific market management capability that reinforces its primacy within OPEC+. The deployment of Saudi spare capacity into Russian export gaps is not simply a commercial decision. It is a strategic communication to every major oil-consuming nation. China, India, European nations managing energy security concerns, Japan and South Korea, that Saudi Arabia is the reliable, scalable, strategically dependable energy supplier that Russian energy has proven it is not. Every tanker of Saudi crude filling the gap left by disrupted Russian exports is a diplomatic message about where energy security ultimately resides in the current global order. The relationship leverage gain is the third dimension of Saudi advantage, and the one whose long-term consequences for Saudi geopolitical positioning are most significant. Energy crisis conditions create relationship leverage in ways that normal market conditions do not. When consuming nations are managing genuine supply uncertainty, the producer that can credibly offer supply stability commands a specific form of strategic attention and political accommodation that normal commercial relationships do not generate. China's relationship with Saudi Arabia is being deepened by the specific conditions of the current crisis. Chinese energy security concerns about Russian supply reliability, combined with the Iranian supply uncertainty, are increasing Beijing's dependence on Saudi crude in ways that strengthen MBS's leverage in the bilateral relationship beyond what the volume of trade alone would establish. The specific financial architecture of the Saudi-Chinese relationship, the non-dollar settlement mechanisms, the investment relationships, the strategic partnerships documented in previous analyses, are being reinforced by the energy security dependency that the crisis is creating. India's relationship with Saudi Arabia is experiencing a similar deepening. India has been the most aggressive in developing alternative energy supply relationships, exploiting discounted Russian crude through the specific period when it was available, developing Iranian supply through sanctions, circumvention channels. But the supply uncertainties created by both the Russian infrastructure disruption and the Iranian succession crisis are pushing Indian energy planners toward the Saudi relationship as the most reliable foundation for Indian energy security. MBS has been cultivating the Indian relationship specifically as a component of Saudi Arabia's diversification of its strategic partnerships beyond the traditional American-centric framework, and the crisis conditions are accelerating the Indian relationship development in ways that serve this strategic objective. The European relationship leverage is being rebuilt through the specific mechanism of the energy crisis in ways that the diplomatic damage of the Khashoggi murder and the human rights concerns of the intervening years had complicated. European governments managing energy security concerns in the context of continued Russian supply unreliability. The sanctions-driven reduction in European dependence on Russian energy has been only partially replaced by alternative supplies, and the additional Russian infrastructure disruption documented in previous analyses is adding further pressure, are recalibrating their relationships with Gulf producers in ways that give Saudi Arabia diplomatic leverage it had not previously been able to exercise in European contexts. The OPEC Plus management gain is the fourth dimension, the specific strengthening of Saudi Arabia's dominant position within the coalition that manages global oil supply through the crisis conditions that have revealed the limitations of the coalition's alternative leadership. Russia's ability to coordinate effectively within OPEC Plus has been significantly reduced by the combination of its domestic military and economic crisis, the infrastructure damage to its production and export capacity, and the specific management challenges of an energy sector whose operational priorities are being significantly affected by the wartime economy conditions documented in previous analyses. A Russia that is managing production disruptions, repair prioritization, and wartime logistics challenges is a Russia less capable of the sophisticated, analytically grounded OPEC Plus coordination that effective coalition management requires. The UAE's independent positioning within OPEC Plus, the specific pattern of Abu Dhabi divergence from Saudi production preferences documented in the analysis of MBS's Abu Dhabi confrontation strategy, has been partially constrained by the crisis conditions that have reduced the UAE's margin for the specific kinds of deviation from Saudi preferences that normal market conditions allow. A crisis that demonstrates Saudi Arabia's indispensable role in global energy market stability is a crisis that reduces every other OPEC Plus member's political space for challenging Saudi leadership within the coalition. MBS's management of OPEC Plus in the current crisis conditions is demonstrating the specific form of strategic value that coalition leadership provides, the ability to coordinate supply decisions in ways that serve both market stability and the coalition's collective revenue interests, in conditions where individual members' rational short-term interests would otherwise produce a coordination failure. The crisis has created the conditions for exactly the kind of Saudi leadership demonstration that the OPEC Plus framework was designed to enable, and MBS is executing it with the confidence of a leader who prepared for these conditions and positioned his coalition management accordingly. The Vision 2030 funding position improvement is the dimension that most directly connects the oil strategy's success to the domestic transformation agenda. The fiscal pressure that the deliberate production increases had imposed on the Saudi budget was a calculated short-term cost that MBS accepted as the price of the geopolitical objectives the production strategy was designed to serve. The crisis conditions that those objectives have contributed to producing are now delivering the market price increases that relieve the fiscal pressure, improving the Vision 2030 funding position at the moment when the program's most capital-intensive implementation phases are approaching. The NEOM development, the entertainment and tourism infrastructure expansion, the technology sector investment, and the human capital development programs that constitute Vision 2030's implementation all require sustained capital flows from the PIF, whose investment capacity is directly linked to Saudi Arabia's oil revenue position. Better oil revenues in crisis conditions means better PIF investment capacity means better Vision 2030 implementation momentum, exactly when the program needs the momentum that the recent fiscal pressure was threatening to constrain. The non-dollar pricing strategy gain is the dimension whose longer-term implications extend furthest beyond the immediate crisis. The crisis conditions are accelerating the adoption of non-dollar oil settlement mechanisms in ways that normal market conditions would not. China, managing energy security concerns about Russian supply reliability, is more motivated than ever to develop the financial infrastructure that gives it secure, sanction-proof access to Saudi crude. The non-dollar settlement architecture that Saudi Arabia and China have been developing, the yuan-denominated pricing mechanisms, the gold-backed settlement options, the bilateral central bank arrangements, is finding more willing adopters in crisis conditions when the specific vulnerability of dollar-dependent settlement to American foreign policy pressure is most visible. India, watching Chinese development of non-dollar settlement for Saudi crude, is motivated to develop its own equivalent arrangements to ensure it is not disadvantaged by Chinese financial infrastructure development in a domain that both countries' energy security depends on. The competitive dynamic between Chinese and Indian non-dollar settlement development with Saudi Arabia is accelerating the overall trajectory toward the de-dollarization of oil trade in ways that MBS's strategy was designed to encourage. Now let's acknowledge the complications. Because MBS's strategy is working, but it is not working without costs and risks that honest analysis requires confronting. The Iranian succession crisis creates a specific complication for MBS's regional strategy that the oil market gains do not fully offset. A collapsing Iran, whose regime might fragment in ways that produce uncontrolled escalation, rather than the managed pressure campaign that Saudi strategy has been conducting, is a different strategic problem than a pressured but functional Iran, whose behavior can be influenced through the specific levers that Saudi Arabia has been deploying. The specific downside risk of Iranian collapse producing regional chaos that affects Saudi Arabia's own security and economic environment is the risk that MBS's strategy has been managing carefully, and that the deepening crisis is making harder to manage. The Russian relationship complication is the second cost of the strategy's success. A strategy that benefits from Russian production disruption is a strategy that profits from the suffering of a country that Saudi Arabia has been maintaining a working relationship with through the OPEC Plus framework. The specific diplomatic management of profiting from Russian weakness while maintaining the Russian relationship at a sufficient functional level to sustain OPEC Plus coordination is a balance that becomes more difficult as the asymmetry between Saudi gains and Russian losses grows more visible. The American relationship tension is the third complication. American policymakers who observe Saudi Arabia's strategy, benefiting from Russian production disruption that American-supported Ukrainian strikes are producing, are making calculations about the specific moral and strategic complexity of a relationship in which American military support for Ukraine is contributing to oil market conditions that benefit Saudi Arabia, while Saudi Arabia simultaneously pursues the oil strategy, the non-dollar pricing development, and the Chinese relationship deepening that create friction with American interests. Despite these complications, the fundamental assessment stands. MBS's strategy is working. Saudi Arabia is gaining as the oil crisis deepens. The specific preparation, the specific positioning, and the specific patience of a strategy that accepted short-term costs in service of long-term positioning is producing the results that the strategy was designed for. The oil crisis is deepening. Saudi Arabia's position within it is strengthening. And the man who designed the strategy, who saw these conditions coming and positioned his kingdom to gain from them while others managed them as crises, is watching the most consequential chapter of Vision 2030's geopolitical foundation be written in oil prices and strategic relationships, and the specific mathematics of supply and demand in a disrupted global energy market. MBS planned for the loss of others. He built Saudi Arabia's position to gain from it, and the oil crisis that is deepening across the global energy market is proving, in the most concrete and financially measurable terms available, that his plan is working.